China just greenlit Nvidia's H20 AI chips for sale. Quite an unexpected move, really, and it's got everyone asking, is the chip war finally thawing?
Yeah, that's the big question.
This isn't just some headline. It feels like a significant reversal in U.S. policy. It's already sending, well, powerful ripples through the market. Welcome to the Deep Dive, your way to get genuinely well-informed fast. We unpack the most important nuggets of knowledge from today's market-moving sources.
And you'll definitely want to be informed today. Futures are looking decidedly green across the board. S&P 500, NASDAQ futures, both climbing. Tech stocks are really leading the charge.
Okay.
Specifically, the NASDAQ 100 is up, 0.6%?
Huh.
Largely buoyed by a pretty significant pre-market pop from Nvidia. Their shares jumped around 5% on this news.
And that's just the immediate reaction, right? Beyond the market open, we've got this sort of triple bill of economic events lined up for today. Investors are keenly watching these to really understand what's moving things.
Absolutely. It's a busy day. First, kicking off Q2 earnings season, we have some huge names in banking reporting. Think JP Morgan, Wells Fargo, Citigroup, Bank of New York Mellon. Their numbers are going to give us a crucial pulse check on the economy. Then later today, the Bureau of Labor Statistics drops June's Consumer Price Index, the CPI data. And economists are actually expecting a tariff-driven uptick here. They're forecasting both total and core CPI to tick up to 0.3% monthly. That could signal, reacceleration of inflation.
Right, more inflation pressure.
Exactly. And if that weren't enough, 4 Federal Reserve officials are scheduled to speak today about the U.S. economy. So, more commentary on interest rates. Plus, there's that recent news. U.S. Treasury Secretary Bessent announced a formal process and started to identify a potential successor to Fed Chair Jerome Powell. So lots happening on the Fed front, too.
Wow. So how does this all connect? The tariffs, inflation, earnings?
Well, the interplay of all these factors, the tariffs, the inflation numbers, corporate earnings, it's all going to heavily influence the Fed's next move on interest rates.
Okay.
Although the market seems to be largely expecting a rate hold this month. Maybe cut in September.
September, okay.
It's definitely a complex set of cross currents to navigate right now. Oh, and on a related note, BlackRock's assets under management just surged to a record $12.53 trillion in Q2, boosted by market rallies, likely fueled by, trade deal hopes and those rate cut expectations.
That is a lot to process. Okay, Let's zoom back in on this Nvidia news, though, because it really does feel like a potential game changer. The U.S. government granting export licenses for Nvidia's H20 AI chips to China is just such a dramatic reversal from the previous administration's stance, which had tightened restrictions so much, it basically choked off a huge market for Nvidia.
Absolutely.
And it's especially notable because Nvidia actually designed that H20 chip specifically to be less advanced, right, to comply with those earlier U.S. trade curves.
Exactly. It was their attempt to thread the needle.
So this move alone could add billions to Nvidia's revenue, just restoring those previously lost orders. But what's really fascinating, I think, is how this ties into the bigger picture, the narrative around why some people see Nvidia as a forever stock.
Yeah, this immediate win really reinforces what many analysts already saw as a long-term, almost unshakable bull case for Nvidia. It's not just about one chip. It's about their whole strategic position. First, you've got Jensen Huang's leadership. I mean, the man founded NVIDIA over 30 years ago, still at the helm, transformed it from gaming chips to this AI powerhouse. His presence, his focus. That's critical for their, let's call it, platform mode.
Right, the visionary founder's still leading.
Second, their growth and profitability are just. Well, they're exceptional. We're talking consistent double, even triple-digit revenue growth. And high profitability, gross margins recently topping 70%. That kind of financial muscle is crucial for long-term investor returns.
70% gross margins.
Wow. Third, innovation is just baked into their DNA. They have this aggressive roadmap promising annual chip updates, Blackwell Ultra, with a plan stretching out to 2028. This relentless, pre-announced innovation makes it incredibly tough for competitors to really catch up or disrupt them.
Keeps everyone else playing catch-up.
Pretty much. And fourth, their ecosystem just keeps expanding, creating more stickiness. They're constantly forming new collaborations, like that recent partnership with HP for AI factory offerings. And they've got serious momentum in robotics, too, with their foundation model for humanoid robots.
Okay, but what about the news that Jensen Huang himself has been selling stock, over $36 million worth recently? Doesn't that send a different signal?
Yeah, that's important context. That sale was done under a Rule 10b5-1 prearranged trading plan. He set that up back in March. It's actually a very standard thing for executives. Lets them diversify their personal wealth over time without causing panic or signaling a lack of confidence.
So it's planned, not reactive.
Exactly. Think of it like a chef taking a small plate of their own food home. They're not abandoning the restaurant. He still holds something like 85 million shares. It's a fraction of his holdings. Okay, that analogy helps clarify things. So, while Nvidia makes its comeback, what other fast-moving developments are shaking things up today? Let's hit some quick ones. First up, Google. They just inked this massive hydropower deal, agreed to secure up to 3 gigawatts of U.S. hydropower from Brookfield Asset Management.
3 gigawatts, that's huge.
Right. They're calling it the world's largest corporate clean power pack for hydroelectricity. Initial agreements are for 20 years. And on top of that, Google's pledged $25 billion for data center buildouts in Pennsylvania and nearby states over the next couple of years. What's driving such enormous long-term energy bets from a tech giant?
Well, the driver is pretty clear. It's the tech industry is absolutely insatiable demand for massive amounts of clean electricity, powering these energy-hungry AI models and cloud data centers. It's pushing U.S. power consumption to record highs. This is after like 2 decades of basically flat demand. Wow, AI is really changing energy demand.
It really is. And what's significant about this Google deal is it fits their broader strategy. They're pursuing these first-of-a-kind power purchase agreements, hydropower here, but also geothermal, even advanced nuclear. They're literally reshaping the energy map to fuel their AI ambitions.
So the tech giants need power. But what about the intelligence inside those data centers? Amazon and Google-backed AI startup Anthropic just launched something called Claude for Financial Services.
How's this different from, say, regular ChatGPT or other general AI?
Yeah, that's a good question. It tackles this issue. How do you make AI truly transformative, not just sort of helpful, in a super regulated field like finance? Anthropic actually talked to a bunch of financial professionals, and what they heard was a need for stricter compliance controls, more domain-specific reasoning from the AI. General models weren't quite cutting it.
Okay, so specialization. Exactly. Claude for Financial Services tries to bridge that gap. It's got a higher query capacity for handling huge amounts of financial data. And it directly integrates with popular enterprise tools, Box, Dalupa, Databricks, Morningstar, Palantir, S&P Global, Snowflake, you name it. The idea is to let finance pros quickly pull and analyze data, making the AI like an industry specialist on their team.
Makes sense. Okay, another quick hit. Speaking of surprising moves, Bank of America just double upgraded a natural gas producer. Went from underperform all the way to buy. They're seeing more than 20% upside. That seems like a really bold call right now. What's the thinking there?
It is a bold call, definitely stands out. The rationale seems to be driven by what BofA sees as stronger tailwinds for LNG, liquefied natural gas. Now, the specific company ticker wasn't in the snippet we saw, but it certainly signals renewed optimism in that part of the energy market. Suggests they see some fundamental shifts happening.
Interesting. And finally, let's hop across the border. High-stakes stuff unfolding. TikTok is urgently pitching Canada a national security solution. What's the situation there?
Yeah, TikTok is basically scrambling to avoid a looming shutdown order in Canada. It sounds like so far their pleas have kind of fallen on deaf ears. They're still looking to get to the table, as the report put it. It's a really high-stakes negotiation. The clock is ticking. It's almost like watching a real-time policy drama unfold, with their entire presence in a major market hanging in the balance.
Definitely one to watch. Okay, let's shift gears now to the banks. Today really kicks off the Q2 earnings season for them. JP Morgan Chase, for instance, just reported Q2 earnings, came in better than expected. And notably, they saw a big deal-making boost. Investment banking fees were up 8% to $2.5 billion, mostly M&A advisory and equity underwriting driving that. Seems like a healthier climate for big deals, maybe?
Well, Jamie Dimon, JP Morgan's CEO, he noted that investment banking activity started slow but gained momentum as market sentiment improved. He also felt the U.S. economy remained resilient during the quarter.
Okay, so some positive signs.
Yes, but, and this is crucial, he also flagged some serious notes of caution. He pointed out that significant risks persist. Things like tariffs, trade uncertainty, worsening geopolitical conditions, high government deficits, and elevated asset prices.
Right, the usual list of worries from Dimon.
Pretty much. And it's important to clarify JP Morgan's headline net income number. That reported 17% drop to $15 billion. It was largely skewed by a big one-time gain on Visa shares they had last year. If you exclude that, and a specific tax benefit, their profits actually rose 9% year over year to $14.2 billion. So the underlying picture was stronger.
Got it. Context matters. What about other banks?
Right. Wells Fargo also reported they beat profit estimates, but, and this hit the stock pre-market, they cut their 2025 net interest income guidance. They now expect it to be roughly flat with 2024 levels.
Ouch. NII guidance cut.
Yeah, that wasn't well received. But interestingly, their investment banking fees were also up by 9%. And the key thing for Wells Fargo, the Fed just lifted that 7-year-long $1.95 trillion asset cap last month. That finally allows them room for unimpeded growth again.
Big deal for them.
Huge. And we've also got Citigroup and Bank of New York Mellon reporting today, too. So we'll get a much fuller picture of the banking sector very soon.
Okay, let's switch to our smart money minute. We hear so much about passive investing, right? Index funds, ETFs, pitched as the simple set it and forget it way. But are there maybe hidden risks people are overlooking? Is there a case for being more active?
It's a really important question because according to a recent analysis from VectorVest, passive investing does kind of force you to own the good, the bad, and the ugly. Think about the Magnificent Seven tech stocks. Earlier this year, they made up nearly 32% of the S&P 500. So with an index fund, you get heavy exposure there, which has been great lately, but you're also forced to hold hundreds of other companies that might be underperforming.
You own the whole haystack, not just the needles.
Exactly. VectorVest uses an example. Compare Walmart, which their system might rate a BUY based on strong financials and upper price momentum versus, say, Tesla, which maybe they rate a hold due to weaker long-term potential or momentum at a given time. An S&P 500 ETF makes you own both, right? Even if their analysis says one is a much better bet right now.
And what about timing?
That's the other key point they make. Passive investing inherently ignores market timing. But buying at the wrong time, think right before the dot-com crash in 2000 or the financial crisis in 2007 can lead to really significant losses. We're talking 40–50% drops sometimes.
So what's their alternative?
They propose a simpler, data-driven system for actually selecting stocks. Their mantra is pretty clear. Buy safe, undervalued stocks, rising in price in a rising market. It boils down to focusing on companies they assess as undervalued, using their relative value metric, financially strong, relative safety score, and showing upward momentum, relative timing, and crucially, only investing when their indicators show the overall market is trending up.
So applying specific criteria.
Right. And they applied these criteria to currently rate stocks like, for example, Amazon, Meta, and Broadcom as BUYs, according to their system.
Okay, so what does this all mean for you listening right now? This perspective really forces us to ask, is average truly good enough for your financial goals? Or does understanding these market dynamics maybe empower you to selectively look for greater opportunity, even understanding the risks involved? If you do want to take more control, try to avoid just average returns, well, you need data-driven insights. And that's exactly where Theta Fuse's upcoming premium list can potentially help you spot those kinds of opportunities. All right, let's quickly recap the key insights from today's deep dive. First, Nvidia getting the green light for H20 chip exports to China. It signals a potentially significant shift in U.S.-China tech relations, and it's obviously a major revenue boost for Nvidia.
A huge win for them, definitely.
Second, Google's massive $3 billion hydropower deal. It really underscores big tech's growing, almost desperate need for energy and their role in driving huge clean energy investments.
They're becoming major players in the energy sector itself.
Third, JP Morgan's Q2 earnings showed a solid rebound in deal-making, even though Jamie Dimon remains cautious about those persistent risks. Meanwhile, Wells Fargo faced an NII forecast cut, but they do have that asset cap lift providing a tailwind.
Mixed signals from the big banks.
Fourth, the debate over passive investing isn't over. New arguments highlight potential hidden risks, urging investors to maybe consider more data-driven strategies instead of just blindly following indexes.
Food for thought on strategy.
And finally, TikTok is in urgent talks with Canada, trying to avoid a shutdown. It just illustrates those ongoing high-stakes regulatory hurdles for global tech firms.
Definitely a complex landscape out there. And just a crucial reminder for everyone listening, all the information we've shared today is for informational purposes only. It should absolutely not be considered investment advice. The market is dynamic, it's volatile, and past performance doesn't guarantee future results.
Absolutely. Always do your own thorough research and seriously consider consulting with a qualified financial advisor before making any investment decisions. So, given everything we've discussed today, here's a thought to leave you with. How much are you actively shaping your financial future right now versus just letting the market's tides decide for you? What's your next strategic move? Like, share, and subscribe to Theta Fuse for your daily spark. This is Theta Fuse, where your money meets momentum.